Welcome to The Explainer. Today we're diving into a pretty powerful but maybe lesser known financial tool that could really change how you think about retirement. It's called the Flex Payment Mortgage. So, here's what we're going to cover. We'll start with the big retirement challenge so many of us are facing. Then we'll get right into what a flex mortgage actually is and, how it works. From there, we'll look at some real-world strategies, and then, of course, we'll wrap up with the fine print, the stuff you absolutely need to know. Let's just kick things off with a pretty eye-opening number from the Journal of Financial Planning. 53%. That's more than half of all households at risk of not having enough money to keep up their standard of living once they retire. That's a huge number. And that number isn't just a statistic. It points to a very real fear that so many people have. And it's exactly why new financial ideas are being looked at, which brings us right back to this flex payment mortgage. So, given that pretty big challenge, you have to ask, how can homeowners use the assets they already have to close that savings gap? Well, one potential answer lies in this tool. All right, so what is this thing? Well, you might hear it called by its official name, a Home Equity Conversion Mortgage, or HECM for short. But here's the bottom line. It's a special kind of loan for older homeowners that lets you tap into your home's value without, and this is the key part, without having to make monthly mortgage payments. Now, these generally come in two main flavors. The one you hear about most is the federally insured HECM, which is backed by the FHA. But for more expensive homes that are over the FHA's limit, there are also private options, sometimes called jumbo loans.
Okay, let's get into the nuts and bolts. How do these mortgages actually function day to day?
The first big question on everyone's mind is probably, okay, so who can actually get one of these? And yeah, the requirements are pretty specific.
So there are rules for you, the borrower, and for the property itself. For you, the big ones are you generally have to be 62 or older, you have to own and live in the home, and you've got to be up to date on your property taxes and insurance. And one step you can't skip is a counseling session with a HUD-approved agency. Then for the house, it just needs to be a property type that the FHA approves.
Now, once you qualify, you've got choices. You could go with a fixed-rate loan. That's where the interest rate is locked in, and you get all your money in one big chunk right at the beginning. Or you could choose an adjustable-rate loan. That gives you a line of credit, which means you have more flexibility to draw funds as you need them over time.
And how much can you actually borrow? Well, it's not a random number. It's a calculation based on three main things: how old the youngest borrower is, what your home's appraised value is, and of course, what the interest rates are at that moment.
The process to get one is actually pretty straightforward. It all kicks off with that mandatory counseling we talked about. From there, it moves through the usual steps, like underwriting and appraisal, all the way to closing. The whole thing usually takes somewhere around 25 to 30 days.
Okay, now for the fun part. This is where the concept really comes to life. Let's see how this all works in the real world with a couple of different buying strategies. It really helps to see how this fits in when you stack it up against the other options. A traditional mortgage means monthly payments chipping away at your cash flow. Paying all cash is great, but it ties up a ton of your liquid assets. This flex payment mortgage, it's kind of a middle ground. You get to ditch the mandatory monthly payments, but you don't have to sink all your cash into the house. All right, let's run the numbers on a downsizing scenario. Let's say you sell your home and walk away with about $644,000. You find a new, smaller home you love for $500,000. Now, instead of paying all cash, you use a flex payment mortgage. Your required down payment is only about half your cash. And the result? You're in your new home, you have zero mortgage payments, and you still have over $300,000 of cash in the bank. That's a huge buffer.
But what if you want to go the other way? What if you actually want to upgrade your home in retirement? Well, using that exact same $644,000 from the sale, you could actually buy a $1 million home. Yeah, you'd use most of your cash for the down payment, but it makes that major upgrade possible without totally draining your savings.
Okay, but with any big financial move, you absolutely have to understand the fine print. So let's be super clear about what your responsibilities are, and also some of the unique protections that come with this type of loan. Now, this next point is huge. It's probably one of the most critical features to understand, and it's a fundamental protection for you and for your family. It's the fact that this is what's known as a non-recourse loan.
So what does non-recourse actually mean for you? Well, think of it this way. The house is the only thing on the line. The loan is secured only by the property itself, so your other assets are safe. And here's the kicker. If the loan balance ever grows to be more than the house is worth, neither you nor your heirs are on the hook for that difference. The lender can't come after anyone for the shortfall. The house is it.
Okay, but here's the other side of the coin, and this is super important. No monthly mortgage payments does not mean no payments at all. You still have absolutely mandatory responsibilities. You have to pay your property taxes and your homeowner's insurance on time. You have to pay any HOA dues, and you have to keep the house in good shape. If you don't do these things, you could actually default on the loan.
And so, all of this really brings us back to one big, thought-provoking question for any homeowner out there. It really challenges you to look at your biggest asset, your home, as more than just a place to live, and to ask yourself, could the equity you've built up be a powerful, untapped part of your retirement plan?